Hey, everyone, and welcome to the show today. Today, we are joined by Chad Sutton. Chad is one of the 5 managing partners at Quattro Capital, leader of the acquisitions team, and the host of the Real Estate Runway podcast. Chad's a recovering engineer who spent most of his profession in corporate America in spaceflight with NASA and aircraft with GE before following his passion as a real estate investor. He's an old soul and a genuine family man, passionate about building a time quality lifestyle and quality communities for residents. Chad, welcome to the show.
Dave, good to see you again. It seems like only yesterday we were recording on my show. So good to see you on this side.
Yeah, it does for sure. Tell everyone, how do you go from, working in NASA and engineering to get into real estate, right? You probably get that question a lot.
I do. And it's kind of a funny story, right? So as a kid, I was always a little technically inclined. I built Legos, Connects, erector sets, anything you can imagine. I was that guy, right? And I would be building tree houses out back. So at some point I was told, you need to be an engineer. And I was pretty good with math and numbers as a kid. So I listened. I went that route. I chased the corporate dream of being a top level engineer. And I went there. I went to school for 2 degrees, one while working. I worked in some pretty interesting fields, working for NASA back when the space shuttle was still flying. So I got to work on things that go boom and really fast. I got to work on aircraft after that for many years, and then subsequently renewable energy products like wind turbines. So lots of really cool technology. I really enjoyed being an engineer. What I didn't enjoy was the economics of it. The fact that you realize after a while that you're really just a highly paid hourly worker, right? And every design project you do, the resources you're given and the budget you're given goes down, right? And so they're always trying to squeeze, the tech companies are always trying to squeeze engineering down, which means the quality of life is not great, right? You're always kind of trying to get to that extra income rung, and you're always doing more work for less money. I realized that at an early age and decided to despecialize. Right around the time I decided to do that, 2 things happened. One, the General Electric stock price went from like $40 to $5 or something, if you remember that. It was a pretty big.
We were a shareholder at the time.
Yes, yes. A lot of people were in that blue chip dividend paying stock that was no longer that way. I went through a couple of administration changes within the company, and we wound up forming an internal McKinsey and Deloitte, or KPMG, if you will, like an internal consulting group. My entire job as a young man, which was pretty neat, I got to fly around the world on GE's dollar, going to every manufacturing facility in the world and focus on what's called variable cost productivity. So my whole job was, how do I make the profit and loss statement better by making products more efficient, right? So the benefit of having been a product engineer and having a little bit of business savvy was I got to go work on this team. And that's really where I gained my business savvy, my P&L experience, a lot of the whole, how do you translate tech skills to numbers, right? My whole job was how to make the business more profitable. And not to mention, I got to go do some pretty neat traveling along the way as well. So anyway, did that for a while. That really despecialized me. That led to a global commodity leader role where I was effectively a global sourcing and negotiating lead for the renewable energy industry. So I was responsible for all the big, heavy electrical, think transformers, think massive breaker boxes called switch gears, things of that sort. And that's what broke me. That's what got me out of corporate America, because my whole essence of being, my whole purpose was to take what I'll call mom and pop small companies and be big bad GE, and quite literally take everything from them. And I was good at it, Dave. I was really good at it. I negotiated a lot of things that really put GE in a good spot, but really put other companies in a bad spot. I would have to go look at these people whom, by cutting volume, I just eliminated 40% of the workforce, type of thing, so very much unethical and immoral for me. It's a necessary part of business, but it's just not where my heart is, right?
Yeah.
Right around that same time, the other thing that happened back when the stock price dropped, one of the biggest influences in my life, my grandfather passed away. Patriarch of the family, big Texas man. If you knew him, he was boisterous, he was loud, he was funny, but he also taught me a lot of what I know in life, and continues to teach me even after he's gone. But he and my grandmother had invested in about 70, give or take, single family rentals as a portfolio in Texas. And I kind of got involved with that and started, this is also around the question, the time I was asking the questions of, why am I trading time for money? How do these people who have all this wealth and freedom, how do they get there? And the common denominator in all these books was some form of real estate, right? Now, it could be a farm, could be single family, could be multifamily, could be commercial centers, anything like that. Really started to focus and realize, okay, it's not just real estate. It's how do you buy assets that produce income, some form of tax benefit. We like depreciation, but there's others out there, and some form of marketable equity appreciation that I can sell later for a profit. And so for me, real estate was the easy way, as it is for a lot of us, because it's attainable. You can get your head around it. I'm not going and buying a tech company. I'm going and buying something that people live in, that I live in, that I understand, right? And so that was really where the transition started to happen. I got to where I wanted to be in corporate America, climbed the ladder, realized I didn't like was at the top of the ladder. And oh, by the way, the further you get up that ladder, the more people are taking a shot at you in the back, trying to get you to fall. And discovered, here's a way to divorce time from income. And I pursued it with utmost passion. And, that's kind of where the story flips over to today.
Wow. That's really cool, Chad. That story about GE, I've got to just share with folks how close to home that hit. In fact, that's really what even, drives my investment thesis even further, right, on the passive income side. So you take GE stock, which was considered, one of the most blue chip, stable companies you could have in your portfolio. And my wife was from upstate New York, and her dad, worked his whole life and, invested into the market. Luckily he invested at an early time, and, there was some good appreciation there into some of these stocks like GE, IBM, Kodak. And we literally, it was very sentimental to her, right? These stocks. But when GE, like the stock, completely crashed like that. And then she also had Kodak, right, which went bankrupt. And I say that, Chad, because it's interesting, right? Because the, financial services industry has us thinking that you have the most security and liquidity by investing in financial markets. But I would completely argue that, right? When something here as, financially stable as that, Kodak literally went bankrupt. And if you're at the end of your, curve in terms of, let's say, your retirement and you're on fixed income, you probably don't have everything in bonds at that point, but, you watch your portfolio just blow up by something like that, that's supposed to be stable. I think there's some faulty assumptions out there.
I would agree with that. And, I think the public tells us, and by the way, the publicly notable financial advice is those with the biggest marketing budgets, right? So let's think about that for a second. The thing everyone knows is the thing that everyone sees, and that is, mutual funds, stocks, bonds. That's where a lot of money is made, and a lot of marketing is spent trying to get your money in it. So taking it from there, I totally agree that this is something. I think there's some faulty assumptions. There's some misadvice, and I've learned to be wary of shiny brochures, right? There's been a lot of people who have looked me in the eye, shaken my hand, and said, here, this is going to be great, and then it wasn't, right? So those are situations where I hadn't done my own personal due diligence. I didn't truly understand how what I was investing in worked. I had money in GE as well, right? I thought I understood it because I was an employee in the company. I had no idea what was going on in that business. And further, the biggest problem with publicly traded companies, in my opinion, this is Chad's opinion, this is not saying they're all bad, but there could be a turnover in leadership, or a CEO could leave and gut the company with his C-suite team overnight, and the stock's going to tank before you know about it. And you have no control of that, right? When is the last time you could call up Steve Jobs when he was alive and ask him, why are you making this decision? You don't get to do that. So in my opinion, the bigger and more sound the investment is perceived may not be the case.
Right. I mean, I spent a lot of my career working for Fortune 500 companies in my prior company, which was a consulting company. And we did similar things, right? Is trying to essentially make them, faster, better, cheaper, right? At different levels.
Right.
And it was interesting because the larger the company, the more complexities that they really had, the more disconnects that they really had in different thinking and everything. So you're right. You invest into a public company, and there are a lot of things outside of your control, leadership changes, and then there's other things. I mean, just think about a few months ago, it was, there was a drop in the markets by 3% in one night because of a Chinese conglomerate, fallout, right? That happened completely across the world, and you have absolutely no control over that, right? So what else, Chad, do you think is wrong with, the current kind of investment thesis of and how Americans are really investing today?
I think the biggest thing is we've become generationally acceptable with or accepting of the fact that investments should only earn you 6 to 8% or something like that, right? On a total. And that's not even your aggregate, because then you pay taxes on it in some way, shape, or form, right?
Yeah.
So when you really think about it, if we take the basic assumption that inflation stays at 2 to 3%, which we know it has not, right, recently, but in the past 10 years, right, inflation had been running at 3%. If you're really only netting, let's say 7%, you're making 4% on your money, and that's acceptable, right? I think the biggest, and I struggle with new investors in our company sometimes, because I have to explain to them that, okay, when I'm showing you something that will make conservatively 20% annualized return, if not better, whether it's real estate or some sort of a crypto fund or something else, you have to kind of explain that this isn't too good to be true. Like there really are ways to accelerate the multiplication of your money much more quickly than the perceived safe way. Does that make any sense?
Yeah, absolutely. Because there's a multiplier effect. And I think, like you were talking about, right, the public markets and their shiny brochures want you to just think of, we think in our brain that there is a rate of return on some type of investment. And it's very one-dimensional. So this one is 7%, that one's 8%, so it must be better. That's kind of all we think. And that's why we like to talk a lot about wealth strategy here, because it's really about putting lots of pieces to the puzzle together, right? So we've got tax strategy and tax planning that goes into an investment, so that, you can potentially have your income stream, coming in that's completely tax-free. You've got that passive income, which actually gives you an additional source of income, right? So if you're out of work or another opportunity doesn't pan out so well, right? You have diversity in your income stream. So there's some protection from that standpoint. And then, as you pointed out, it's that, appreciation on the back end where you're trying to drive that value. And as you really well put, really trying to optimize assets, right? And take that management control and force the value into that. So it is definitely a multiplier.
Yeah. And another thing I'd like to add in here, and I'm going to be vulnerable for a second, David. I'm going to give you actual numbers, right? I am a 33-year-old male. I'm married. I have 2 kids, right? And I am a millionaire several times over, and I'm growing rapidly because I have broken the mold, and I invest in hard assets. It doesn't just mean real estate, but it means a hard, tangible thing that has 3 components. It has the ability to produce some sort of an income, whether a little or a lot. It produces some sort of an income while I hold it. It has some sort of a tax advantage, whether it be I can write off that income with depreciation or something of the sort, or maybe it's a tax credit. It just depends on what I'm in. And it has the third benefit that I can capitalize on that income stream as I grow it, as I add value to it, and sell it for more later based on what the market is willing to pay for that income stream. So the thing I want to say here is, the conventional wisdom tells you to go into paper assets, right? We think that stocks, bonds, mutual funds, things of that sort that are readily available, they're easily tradable. Those are the best way to go, because you can be liquid in a second, and you hope you have the discipline to buy low and sell high. But reality, most of us don't. If an investment is too liquid, we become emotionally attached to what the line is doing. And if the line starts to move, we're like, oh, sell, sell, sell. And we wind up selling at the worst time, and then when things are going really, really well, oh man, I'm going to sit on the sidelines and watch it grow. Okay, now it's time to buy. And you buy at the worst possible time. So the majority of people who even try to do this themselves in paper assets that are liquid, they wind up shooting themselves in the foot because of their own emotions, right?
Right.
So I guess the summary here for me, I prefer illiquid hard assets because I can't freak out and sell it, right? And I get those three benefits we talked about. So really there's four benefits there. And oh, by the way, nobody can come to me overnight and say, oh, guess what? The company folded up because, like I'm thinking Enron here, the company folded up because we found accounting fraud and now everyone's money's just gone. Sorry, it doesn't work that way, right? There's still a hard thing. Like if it's an apartment building or a single family home or a farm or what did you mention earlier? A cryptocurrency.
Bitcoin mining. Yes.
Yeah. Bitcoin mining, right? That's a hard asset. It's still there. It's going to have some intrinsic value.
Right.
Even if the business plan doesn't pan out.
Right. Absolutely. So do you have a personal, like an overarching wealth strategy personally that you've been deploying?
I absolutely do. And the asset portion of it is just a piece of it. You're always looking, in my mind, at what are your three pillars, in my opinion. That there are what's generating your equity, there what's generating your cash flow, I guess four. You have some form of insurance, and then you have a place to store liquidity. So that's kind of how I look at things. So, and my business actually runs these assets that we invest in, so that, I get my equity creation is the value add that I'm adding to other investors. I make money on that. I put my money in the deals with investors, and my money makes money that way. In the same way my investors' money makes money. And so I get the benefit of the cash flow, the appreciation and the depreciation that we talked about over time. But then I get money, eventually you get money coming back, and you got to think about what to do with it. Well, it's not safe sitting in a bank. It's losing money, and banks go bust every now and then. If you look back at history, that happens. So I use properly structured whole life insurance as a storage vehicle. It's a better savings account, if you will. Don't think of it as insurance. Think of it as a savings account. That's a whole other topic, infinite banking strategy, if you're curious. And that is where I kind of house liquidity. So if I needed to get $200,000 tomorrow, I don't pull it out of my checking account. I go to my life insurance policy, say, hey, give me a loan against that. I take the insurance company's money while my policy is still growing at 7% a year or something like that. So it gets two jobs. I then go deploy that into an asset of some sort. And then when it comes back with its friends, I'll go pay that loan down and buy another policy. So I'm always expanding my liquidity. And then the insurance side of it is, those policies I spoke of are also insurance. They do have a death benefit. I do carry some sort of, depending on the assets that I'm in, I carry whatever appropriate insurance to protect my investment is, that can be there. I actually still carry some disability insurance. Most people don't think that's worthy, but as long as I'm a provider for my family, I want to make sure if I can't do what I do anymore for some reason, there's still a little bit there. So, those are kind of my four pillars, right? It's insurance. It's where do I house my liquidity? It's where does my equity go? And then where does my income come from?
Yeah, that's awesome, Chad. Definitely resonating. We actually, I spent many months actually getting my insurance license so we could work to provide this solution to our investors, because you just nailed it right on the head, right? I mean, when you can do, two things with the same dollar, right? And have these multiple purposes, right? Of having the liquidity, the savings to be able to access that while it's compounding completely tax-free. You can give it to your heirs tax-free. I mean, it's just such a great strategy that, everyone should really have it in place. But, unfortunately, there's just a lot of, misinformation, or frankly, people aren't, have never even really heard about it before. And it needs to be structured the right way before you do it. So,
and let's talk about that for a second, because I really glossed over a lot there. We think our money is safe in the bank if it's FDIC insured. Well, I'm going to tell you something, and this is not a conspiracy theory. There's a book I can quote on this that'll tell you all the grim news, but it's like a red pill, blue pill thing. If you eat the red pill, you're never going to go back. Your money is not safe in a bank. The bank wants it there, but the bank lends out your dollar 10 times over, right? And so the bank never has enough money to pay all its depositors. That is just how banking works. It is what it is. you have to keep some money in there because banks are where transactions happen. So you're always going to be moving money in and out, but you don't want to keep all of your liquidity, all of your cash sitting in one bank for sure, or even multiple banks, because what happened in 2008, sometimes the FDIC and the Fed, they will let banks that are non-solvent go under. And if you're in that unfortunate group, your money's gone, And so, or what'll happen is the government will print more money on the backs of the taxpayers anyway and give it back to you. So it's really not a good situation either way. But when you take that risk to the side, and then you think about how necessary the function of banking is. I mean, it's the best business out there. If you're going to buy or build a business, man, if we could figure out how to build a bank, that is a way to make money, right? That is the most profitable business out there. Everybody needs it, and the profit margins are ridiculous. So think about it this way, though. You put $100,000 in a bank. They pay you what's the going rate today? 0.1% or something, maybe?
Yeah, if that.
Something like that. So that's what, $100 a year on here, if I did that math right. And so, whereas if you put, and oh, by the way, that 0.1% is taxable income. You get your little silly statements every year from your bank account that are like, a taxable 25 cents or something. And then, or you could go put this in one of these policies, and that money will sit there and generate, probably closer to 4 to 7%, depending on what policy you set up. So just on the nature of that, the storage vehicle is much better in the insurance policy. And oh, by the way, insurance companies haven't failed in 250 years. And if they do fail, the world's got bigger problems than your liquidity, right? So from a safety and just cost efficiency perspective, it's not well known because those with the biggest advertising budgets don't want you to know it.
Yeah. It's one more asset, right, that has that multiplier effect and is doing, multiple things. And that's why, I think it's so, smart. And that's what savvy investors, and also if you look at family offices, right, and some of the most, ultra high net worth folks, they're leveraging this strategy, right? And they're putting all of these things together. But I'd like to point out something that maybe listeners, may or may not have picked up on by, all of these points that Chad's making so eloquently, right? There's an underlying theme here as well that's really all about taking back control of your financial future and your family's future, right? And again, kind of coming out of that other, Wall Street mentality, and what they're telling us is that, we're not smart enough to manage our own money, right? Or we don't have enough time, right, to do that. But as you start to get a little bit more educated on some of these, strategies and tactics of what you can do, and you have that liquidity, in your infinite banking policy, you're getting cash flow that's coming in through multiple streams to, provide some of that protection. You have asset protection in place. You have equity growth, and your assets just keep kicking off more and more passive income. It's extremely powerful, right, to get back that control.
It absolutely is. And there's one of my favorite books out there. It's written by my friends, Jake and Gino out of Knoxville. They're a multifamily group. It's called The Honeybee. And it talks about kind of the life of you becoming the CFO of your own financial future, right? I mean, internalize that for a second. Nobody is going to care or give enough, of attention to your personal financial future than you. So you have to become the CFO of your own life. But if you start thinking about, well, what is my core stream of income? And let's say that's a little stream when it starts. And then over time, it kind of starts to become a tributary, and then it becomes a river, right? And then over time, you start to invest or start businesses in complementary areas. For example, I'm in real estate. What if my biggest expenses and what I do are flooring, paint, and cabinetry? What if I decided to go start a shop down those? Excuse me. The one person that can get through, my wife called, it's kind of anyway, so we eventually, those little side streams, they start feeding back into the big stream. And then you have this raging river, you start thinking about your investments, your income streams, your storage vehicles, all those kind of feed back into each other. And then you look down one day and you've taken control of your income stream. You're not building a nest egg, folks. You're building a river that you can walk to whenever you want, take a bucket out of it and drink it, right?
Yeah.
When you build a nest egg, you eat that egg, it's gone.
Yeah. Yeah, no, I mean, there's a simple scenario. I know folks have heard this before, but I love it because it's just such a simple scenario, right? So if you took, traditional theory, right, and retirement theory, and let's say you saved up and 65, you had 4 million. Let's say you had 4 million. Well, they'll then tell you to withdraw 4%, right? So at that point, you're at 160K. Then you take out taxes. There was probably some fees along the way. So maybe it's more like 120K, maybe 110K that you're actually living on. And then you slowly start killing your golden goose each year, right? The 4 million gets smaller and smaller and smaller. So if you just simply take that scenario and now compare that to investing in, just say simply you had, a dozen multifamily syndications, very simply at 4 million, and they could be kicking off 8% in cash flow, which is very realistic. So now you have completely double the amount of income. You have 320K. And ideally, you have enough depreciation, right, that's offset that income. So you've actually more than doubled what your income is. And then the beautiful thing is you're still driving that forced depreciation. So your 4 million continues to get bigger and bigger. And that's how you can start to create legacy wealth, right? And do more for your heirs and do more for others. So it's just such a different, philosophy. But when you simplistically put it that way, it's like, well, which side of the coin do you want to be on, right?
Yeah, that's exactly right. And it just further accentuates the point. I mean, if we're told to build a nest egg, and you hope you built an egg that lasts you long enough to eat off of, or you mentioned a golden goose, right? You hope that golden goose can produce enough eggs, but if you pull all its eggs away and it can't produce anymore, then you're stuck. You really want to build a river. And what is a river? A river is a never-ending stream of water,
Yeah.
And oh, by the way, when you get to the bottom, it evaporates, goes back and rains over here and comes back again. So, you can make all sorts of analogies out of this, but you've got to turn your attention as the CFO of your financial future to building your river, building your flow of cash. And that's going to be from things that spit off cash flow and things that just give you capital events over time. We'll call them floods, right? And you can take a bucket and drink water whenever you want to, right? And you're never going to run out.
Yeah.
That is what you're looking to do.
Chad, so as an engineer, do you have any software that you actually run to manage or a dashboard? I mean, or is it all just kind of custom stuff that you're kind of putting together to manage your whole strategy?
Yeah, I really haven't found a commercial tool out there. And maybe one of these days when I'm bored, I'll build, if that ever happens, I'll,
talk to me, because I have a passion to do that. So
yeah, I'd love
let's
to build
connect.
something for people like us. But
Right.
right now, my best tool is Google Sheets, and it's better than Microsoft Excel. But it really just comes down to, what do you own? What's it doing? And where are you at any given time? If you do nothing else, folks, most people never do this. And I think Robert Kiyosaki, and maybe you do as well, I don't know. There's a simple format, that's downloadable anywhere for a simple personal financial statement a personal income statement and balance sheet, right? And the balance sheet is simply going to be, what are my assets? What are my liabilities? And my income statement is, what's my income? What are my expenses?
Yeah.
Right. And there's a book about this. I think Kiyosaki wrote, was it Cash Flow Quadrant?
Cash Flow Quadrant.
Yeah. That actually talks about how most people flow money between these quadrants and how the wealthy people do it. And so you should really internalize that. And if you do nothing else, build yourself a balance sheet, assets and liabilities, and build yourself a very simple income statement, in Google Sheets. And you'd be surprised that you don't have to have it where all your accounts are hooked up and data's feeding and all that kind of stuff. You don't have to have that to know where you are, but you got to know where you are to know where you're going, right? The biggest problem I think people have, most people, present drives the future. What you're doing today will drive what you're doing tomorrow. We want the future to drive the present. And I'm going to quote my coach, Tommy Newberry, on that, because I love that saying so much. We want the future to drive the present. And so you got to think, where do you want to be? Do you want to have a nest egg that you're eating and hopefully you take the last bite before you take your last breath? Or do you want to have a river? Well, you got to design the present to get to that future. you know?
Yeah, absolutely. And I think this dashboard is really underrated, right? And really critical, because it's kind of like you get in your car every day. You wouldn't drive a car with no dashboard, would you? Right? You wouldn't know where you're going. You
Well,
wouldn't know
no.
if you'd run out of fuel,
Yeah.
anything, right? So you want to do the same thing with your financial future, right? So that you can understand, where you're going. And then as you start to see that, it's kind of illuminating to understand, like, say, where your assets are, what liabilities are kind of actually taking away from, your stream analogy, right? Of what you're trying to achieve, right? And when you can start to see assets that, okay, I've got these assets here, but they're not producing me any income, right? I'm just hoping that the markets are going to go up on them or something. So
Yeah.
I think people have a big opportunity to actually reposition capital, and let's just talk about home equity as a perfect example, right? I mean, so
I do
many
that as
people,
well.
right? The markets
Yeah.
have gone up so much in single family homes. And if you haven't refinanced and are fully leveraged in your house to pull out that equity and then put it to use somewhere else, it's basically trapped equity, which has, a rate of return of 0 on it, right?
I would even argue negative, because your personal home is actually costing you money. It's not giving you money, right?
Yes.
So
Yes.
what's interesting about that, I love that you made that point. And, just to conclude the previous dashboard discussion, folks, download Google Sheets on your phone. It'll take you probably an hour tops to put your life in there and figure out what you really have. And then, for you nerds like me out there, you can get as detailed as you want, make it 10 sheets with graphs and charts, or you can have a little one thing that you look at once a week in your pocket. But do that exercise, because what Dave just brought up is brilliant. And it's how I got my start. I had to finally sit down and say, okay, before I started Quattro Capital with my team, before we started, accepting investors into our deals, when it was just us, and we were just saying, how do we buy assets that create income, right? I didn't have cash sitting around. I didn't have it. All my money, I was doing what I was supposed to. All my money was in a retirement account, or I bought a house, or I had car payments, or whatever I was supposed to do, right? I looked at all my assets and liabilities, Dave, and I figured out, well, I've got a poor, at the time I didn't know it, but I was like, I've got a poorly designed whole life insurance policy here that has about 12 grand in value. I've got, a car payment that's about that. Why don't I liquidate that, pay off the car payment? I just increase my positive cash flow. Okay, that's done. And then I'm like, okay, I've got this house that I bought that has almost doubled in value over 5 years, in Nashville, Tennessee. Okay, how can I touch that? I didn't know how. I looked around. I didn't want to just take out another loan. I wanted the way to recycle capital, because I'd learned about this thing called a line of credit. And I figured out there are banks that will let me put a first position home equity line of credit that just paid off my mortgage. And so the day one, let's say I had 500,000 in equity and I owed 100, they pay off my mortgage. Now they're my mortgage, but it's not a mortgage, it's a line of credit. And so now I had $400,000 overnight, $400,000 that I could deploy and put back, deploy and put back, deploy and put back at about 2% interest. So exactly. You want to talk about, I didn't buy or sell anything. All I did was adjust my assets.
Right. Right. And I think people have such an opportunity there. And I even look, I mean, there's another interest. This is really a great topic, Chad. And I love that you've got the engineering background here to back me up. So think about the power of numbers. So in addition to the dashboard, right, and doing some of those manipulations you said to really try to optimize your portfolio of kind of where you are today. But there's some other things that are really key when you plug things into a spreadsheet, that all of a sudden it becomes really quantifiable and illuminating. So, and I'll give you a perfect example of what I did about 10 years ago. I had money sitting in these 401ks, right, that were accruing because, I followed conventional wisdom too, right? And I'm looking at that saying, okay, yeah.
I love where you're going.
The only thing I know, right, is that I'm certain about the future is taxes are going to go up, right? I mean, tax rates are going to go up. And, they talk about this concept of tax deferral, keep pushing it out, keep pushing it out. Well, why would I really want to push it out? Because taxes are going to be higher at that point, unless they're making the assumption that you're going to retire poor and be on a lower tax bracket. But that's not the vision I have for myself as being, more poor. So I took the 401k money, that all that I had, I plugged it into a spreadsheet and I said, okay, even with a 10% penalty, and even with the tax bite that I would take at that time, if I invested that money into some syndications, where would I be? And I think I modeled it. I'm trying to remember exactly what it came out. And it was something like a break even around 5 years. I might have had like maybe 5-6 years was the break even projection. But literally today, I had an asset that sold for, it had a almost 2.2 multiple. So I actually crushed those numbers in 3.5 years. I hit the break even, and now all of that capital is in completely tax efficient. So I'm never going to pay taxes on that capital again. But once I was able to see it in a spreadsheet and say, okay, this is what I'm dealing with, even though, they make you think this 10% penalty is horrible, or paying the taxes, right? But wouldn't you, it's kind of like taking your medicine. Wouldn't you rather pay your taxes on the seed rather than the harvest?
Yeah, absolutely. I love that we just went to this topic. And before I say what I'm going to say, and I'll give this to you guys at the end, go to chadsutton.info. That's chadsutton.info, and send me an email. I don't have the link there yet because we're just coming out with it, but we have a little ebook and a calculator that may actually serve this purpose in a way for you. But Dave's point is brilliant because you can't qualitatively see this until you actually look at it. I did the same thing. I planned to take the hit. I was going to take a 10% hit on about $200,000 plus they'd be recognized as income. Well, guess what I learned? As soon as I went and studied the assets, now this was step one. I was like, okay, first I need to get money. So I did the HELOC thing and I liquidated retirement accounts. So that was another thing I didn't talk about, but another repositioning of assets that you probably don't know you have. And I took the hit because I don't like encumbered money. I don't like the government telling me what I can and cannot do with my money. Right. And the retirement system is that way. Even if you do a self-directed IRA, which some people choose to do, well, that's fine. But that money doesn't help you until you're 65. Otherwise you have to pay taxes on it. So just pay the taxes now when it's a seed. Right. I mean, for me, it was 200 grand. Now it's millions. Right. So 200 grand, it was a lot smaller than taxes on millions, even if tax rates go up or down. So take the hit. And then what you wind up seeing is, if you just put it in a spreadsheet and you look at a couple of things, you're going to make some conservative assumptions. But the problem is you're not going to get the benefit of the home run investments unless you do something, unless you get into the market. He never would have had the opportunity to get that 2.2x equity multiple if he hadn't first projected, well, I think I'll be okay if it only did 1.5x over 5 years, or 2x in 5 years rather, instead of 3. And the market was good and he got it in 3, 2 years. What if the market was not as good and it took him 7? Big whoop. You're still breaking even in 7 years. And then you have tax advantaged money and money that you no longer have encumbered, for years to come. So I couldn't agree more with that topic. And, reach out to me again, chadsutton.info. I'm sure Dave also has something like this, but we have some templates that might get you started and you need to tweak them for your own situation. But all you got to do is just lay it out. And this is not hard stuff. Even if you're a pen and paper kind of person, lay it out on pen and paper. You can do the multiplication along the way and figure it out yourself.
Yeah.
I agree. You have to look at it.
Yeah. Yeah. And I think there's that initial step as well of mindset, right? It's so interesting that a lot of people they just don't get it because they've, been fed all of this conventional wisdom for so long, and they don't really want to get it. And I think, that's really partly the first step is, you have to be a curious person and ask questions and figure out like why. Right? Why is this working this way? And that, that's kind of where I started. And then you start to inundate yourself with consuming all this, information, and you realize like, wow, there's an entirely a different world out there. And then you put it together, quantifiably in your spreadsheets, and you say, I mean, yeah, this does sound too good to be true. What am I missing? And the only regret I have is, why didn't I start earlier?
Absolutely. And I would venture to say everyone listening to this podcast is curious minded, or you wouldn't be here, right? You wouldn't be listening to this right now.
Yeah.
And I think the only other advice I'd give people on this, and I am an engineer, I have been a rocket scientist quite literally, so I know the definition of analysis paralysis here. Okay. But you can't, don't look at one scenario and let the numbers scare you away, right? Everything, whenever I look at an investment, sure, there's the investment that's on paper, what they show me as a pro forma, but I try to figure out what's the best it can do and what's the worst it can do. And then I try to think on probabilities. Okay, well, there's like my 0% chance and 100% chance, right? If the world it falls apart, or if the world is like, stars align. But then think about, okay, well, from the mean line, from the middle line of what it's average going to do, what's maybe like, pretty confident. Maybe I'm like 75% confident it'll be within this band and 75% confident it'll be in this band on the low side. And you start to figure out like this, I call it the design space, but it's really your sensitivity window. It's like, as much as I know about this industry and as much as I know about this investment and what I can find, I think it'll be likely as good as this or as bad as this. Am I okay if it's on the as bad side, And so that's going to help you figure out what your temperature is. If you're investing in a multifamily deal like what we do, you're probably going to have a pretty narrow window that's going to do X or Y. There's not a whole lot more it can deviate to if you have a good operator. But if you're comparing that to a similar return structure, investing in a startup company, well, that's a very different window. I mean, that startup could lose everything and go nowhere, or it could be a 1000x multiple like a PayPal or something like that. Right. So you got to think about it in sensitivity windows. So we're getting a little technical here, but really just think about like, what's the realistic window of what this thing can do? Are you okay with the downside? Are you okay with the upside? Make the investment. Don't let yourself be paralyzed because you might be scared that the 0% chance thing will happen,
Yeah, very, very pragmatic advice, Chad. Let's transition right now into real estate specifically, okay?
Sure.
We're in March 2022. So let's talk a little bit about the market, what's changing for you. I know you're really on the acquisition side. Very interesting times that we're living in right now. So what's really shifted for you? What do you see in terms of the climate for this year?
Yeah. I guess the first thing I'll say, and our company, we're in alternative assets. Quattro Capital is an alternative investing firm, but we are still focused on, multifamily apartments. We are focused on mobile home parks. We still really like the residential space that is in large groups, like large commercial assets. So looking at how those assets are trading today, there's a lot of money out there seeking this asset type. So I describe it as this, if the cap rate is my shoulders, if you're looking at me on YouTube here, the cap rate is my shoulders. And that's simply the ratio by which people pay for an income stream, so the lower the cap rate, the higher the price. Think of all the money that's out there, billions and billions of dollars looking for apartments right now, especially a lot of institutional players. That money is sitting on my shoulders and pushing me down. Right. So the reason that assets are so expensive right now is there's just a lot of demand by the capital out there looking for these assets. I do think that at some point we will see some decompression of that cap rate. Right now, I see it continuing to compress because the fiscal demand is still there. How am I getting deals done today? So we used to buy old assets in, we'll say low end workforce housing areas that are trending. We'd inject a little bit of money, raise rents, your typical value add plan, raise rents and sell it for 2x value in 2 years or something like that. We are not doing deals like that anymore. I do feel that some sort of recession risk is high. We don't know what will cause it. We didn't know a pandemic would show up and cause the one in 2020. We didn't know that the banking system would collapse due to real estate in 2008. We don't know what will cause it, right? We just know that the expansion cycle has been going for a very long time. And the likelihood of a recession in our near future is pretty high. There's going to be something. It's cyclical. So we're focusing our efforts on really good, we call them B-class properties. They're built between 1980 and 2000, solid bones, solid infrastructure, good plumbing, good electrical. We're not wanting to fix any of that stuff anymore. And we will go inject at least $15,000 to $20,000 per unit, which is a lot in the multifamily space, because we're looking to take that property, and we've gotten very good at making it compete with the new builds. And the biggest reason that works is we're behind on construction for years to come with what, people are wanting to, with the number of people wanting to live, a number of households out there. So we are very supportive of the current market in that we're willing to pay more than an asset is worth today, because I'm going to double the NOI. I'm not going to add 20%. I'm going to double it. I'm buying things maybe for way too much money. They're renting at $700, but I've got comps in the area showing $1,200 if I put this amount of money into it and make it compete with that. And I elevate the property to that level. So why do I do that? Some say, wow, you're overpaying for properties. Well, everyone is, right? If you're doing deals right now, you're overpaying for property. What I'm doing is baking in a cap rate decompression. So I'm going to have, even if the market, let's say the market turns back and the cap rate goes 200 or 300 basis points higher, 200 or 300, right? So if you're at a 4, we go to a 7. It's a big move, big move. Well, for one thing, I'm probably not going to sell because I don't have to. By then I'm going to have this thing cash flowing so well at a different clientele of tenant, like 2 rungs up, that I'm okay. And we'll just hold the property. But if I did sell, I've literally doubled, the net operating income on the asset. Go put a cap rate on that, just take a number and do $1 million divided by 0.04 and $1 million and $2 million divided by 0.06 or 7 or something like that. You're probably still going to have tangible equity in that asset. So that's how I'm recession proofing ourselves, is we're baking so much CapEx into an already non-obsolete asset, right? That's the key. It's an asset that's still good, and will compete for years to come.
Yeah.
So I do agree that assets are overpriced, in my personal opinion. That's a relative opinion. I think people are paying, in some cases, way too much for even the value add play, but there are still projects you can put together where that makes sense. And they may not cash flow great in the first year, but they will be really stroking by year 2, year 3. And then they're poised for an early exit. So that's really how we're able to get deals done today. We just had to start looking at things differently and kind of blow up the mold of, okay, you spend $3,000 or $4,000 a unit, raise rents $100 and sell it. It's not that game anymore,
Right. Now, I think we could probably devote a whole episode to this, Chad. So we'll have to get you back and talk about the state of the economics and everything. If you could just give one piece of advice to our audience about growing their wealth, what would it be?
One piece of advice. I'm going to kind of wrap 2 quotes that I said earlier today. Hopefully, if you hear them 2 or 3 times, they'll internalize them. Stagnation is degradation. I guess I didn't use that one yet. Stagnation is degradation. Become the CEO of your own financial future. And for most people, the present drives the future, but we want the future to drive the present. You need to think about that river that you're trying to build, not the nest egg, that river, and start taking action today to figure out what will help me feed a river. And if you do nothing else but follow that the rest of your investing career, you're going to do just fine.
Awesome. Love it, Chad. Where can folks find you? How can they reach out? How can they connect and follow you?
Yeah, so I'm available on LinkedIn, Facebook, Instagram, all that kind of stuff. But everything that my company, Quattro Capital, the website there, it's all available. Just go to chadsutton.info, chadsutton.info. You'll find my social media front and center. You can follow whatever platform you like. You'll find the podcast. You'll find the website, and you'll also have the opportunity to email me if you're looking for that financial freedom calculator we talked about, or any other resource that we don't have posted yet that is coming. So yes, really enjoyed being on, Dave. Thanks for having me on today.
Awesome, Chad. Thanks so much for coming on.